Welcome back to the deep dive. Ever stop and think, how can I really trust that the companies holding my data are, actually keeping it safe? Or maybe from a business angle, how do you make sure your partners are reliable? Not just saying they are, but proving it.
It really boils down to trust, doesn't it?
Yeah,
Especially now, everything being so digital.
exactly. And that's what we're digging into today, performing SOC engagements.
Huh?
Think of it like a really detailed audit. We want to unpack the careful steps auditors take to give us that assurance, to show that organizations are managing systems and info the right way.
It's about getting under the hood, really, understanding how these critical assessments actually work.
Okay, let's unpack this then.
Yeah.
Once an auditor's on board, they've done the initial planning, the risk assessment.
hmm
What happens next? What are the sort of main stages?
Right, so it's not just one single step after planning. The core performance phase, well, it starts with the auditor getting a really solid grasp of the service organization's system. Then they move into actually performing tests, gathering the evidence they need. And this is important, they also have to consider things that happen later.
Later. You mean after the main audit period?
Exactly. Events that occur after the period under review, but before they issue their final report, because those could still matter. Then they pull everything together, evaluate all that evidence, and finally form their opinion.
Okay. And you mentioned key areas within that performance phase.
Yeah, there are about 5 main buckets after the initial risk work. First, they figure out how to respond to the risks they've already identified. Second, they look at management's description of their system. Is it presented fairly, according to the rules, the criteria?
The blueprint you mentioned earlier.
Precisely. Third, they get evidence on how well the controls are designed. Are they set up correctly? Fourth, and this is just for Type 2 reports, they gather evidence on whether those controls are operating effectively over the whole period, not just designed well, but actually working day to day.
Okay, design versus operation. Got it.
Fifth, they evaluate all the results from everything they've done. And finally, step 6, really, is forming that all-important auditor's opinion.
That first part, responding to risk, that sounds really dynamic. How does an auditor actually, shift their approach based on what risks they find? It seems very strategic.
It absolutely has to be. The auditor's main goal is to collect enough good evidence, what we formally call audit evidence, to get their attestation risk down to an acceptably low level.
Attestation risk. That's the risk they might issue the wrong opinion.
Essentially, yes,
Yeah.
the risk of getting it wrong. They need to reduce that risk way down to achieve what's called reasonable assurance.
hmm
That means they're confident in their conclusions, but, well, it's not absolute certainty.
Right. Reasonable, not absolute.
So they design and carry out specific responses to deal with the assessed risks of material misstatement. These are the risks that something important might be wrong or misleading in the description or the controls.
And what drives those risks up or down?
Several things. Materiality is a big one.
Yeah.
How significant would an error need to be to actually matter to someone reading the report?
Mm-hmm.
Also, how strong is the organization's overall control environment? The tone at the top, ethical values, that kind of thing.
Okay.
And other parts of their internal controls related to the services they're providing. If that control environment feels weak, for instance, the auditor might assess risks as higher.
Which means more work for them.
Usually, yes. More intensive procedures, maybe bigger sample sizes. There's a good example. Say an auditor sees a process where employees get bonuses for hitting certain targets.
Okay. Pretty common.
Right. But if the auditor thinks there's a high risk that employees might fudge the numbers to get that bonus, well, they can't just take the results at face value.
They'd have to dig deeper.
Exactly. They'd likely increase their testing on related controls, maybe look at a larger sample of transactions, maybe both. They adapt the plan based on that specific risk.
So what do these overall responses actually look like in practice?
Well, it could be several things. Making sure the audit team keeps up a healthy dose of professional skepticism, not just accepting things easily. It might mean assigning more experienced auditors to riskier areas, or even bringing in specialists if needed, like cyber experts. Providing more supervision over the audit work is another one. Or, and this is interesting, sometimes they deliberately incorporate unpredictability into their testing procedures.
Keep them guessing.
Sort of. It prevents the organization from knowing exactly what or when something will be tested. And of course, they can change the nature, extent, or timing of their tests.
Nature, extent, timing. That sounds important.
It is. Nature is what kind of test. Extent is how much testing. Timing is when they do it. They can adjust all three based on the risk assessment.
Gotcha. Okay, so they've got their risk response strategy. what's the first big piece of evidence they tackle? You mentioned management's description of the system. How do
Right.
they check if that blueprint is, well, accurate and fair?
Right. That's a fundamental step. They obtain and carefully read management's description. Then they evaluate if it's presented fairly based on suitable criteria.
Suitable criteria, like the rules of the road for the description.
Exactly. These criteria define what needs to be in the description and how it should be presented so it's reliable and understandable. It's like checking if the blueprint meets the building code.
So what are they looking for specifically?
Key things include, are the control objectives management set out actually reasonable? Did they really implement the controls they claim they have? And if there are controls that the users of the service need to perform, those are complementary user entity controls. Are those clearly described?
Yeah.
Same for controls handled by any subservice organizations.
Ah, like if they use a cloud provider or a payroll processor.
Precisely. The description needs to explain how those third-party services fit in, and crucially, whether the auditor used the carve-out method.
Meaning they didn't audit the subservice organization's controls.
Correct. Or if they used the inclusive method, meaning they did audit the subservice organization's controls too. That needs to be clear.
Okay, what else needs to be in that description according to these suitable criteria?
It needs to be pretty comprehensive. Things like the types of services provided, the transactions processed, how both automated and manual procedures work, what information is used like accounting records, also how they capture and deal with significant events that aren't just routine transactions, how they prepare reports for their clients or users. And for Type 2 reports, remember, it must detail any significant changes to the system that happened during the period being audited.
That makes sense. Users need to know if something changed.
Absolutely. And the whole description shouldn't omit anything important or contain misleading information, even though it's often written for a wide audience. It needs to be objective.
So how does the auditor actually check all that? Do they just read it?
Oh no, much more than that. They'll consider who the users are and how the services affect them. They might review contracts with users. They often observe the organization's staff performing tasks, review policy manuals, procedure documents, system flowcharts, narratives.
And you mentioned walkthroughs earlier. That seems key here.
Very key. Performing walkthroughs is critical.
So just to be crystal clear for everyone listening, a walkthrough is literally following one transaction, like maybe an order or a data input all the way through the system step by step.
That's exactly it. You trace its path, see which controls it touches, talk to the people involved. It helps confirm the process flow described in the documentation is real.
And what makes a description fail this test? When is it not fairly presented?
Well, for SOC1, it might be not fairly presented if it says controls are being done when they aren't, or if it leaves out relevant controls, especially ones that aren't designed well or aren't working. For its SOC2, it's considered not presented in accordance with the description criteria, if it implies IT components exist when they don't, or if it includes statements that just can't be objectively evaluated or tested. Basically, if it's misleading or unverifiable.
Okay, so the blueprint, the description has been checked. But like we said, a plan is just paper. How do auditors test if the controls are really working? The effectiveness part.
Right, the proof is in the pudding, as they say. This is where we get into tests of controls, and there are two main aspects we look at.
Two aspects.
Yes. First is the suitability of design. Is the control, as designed, capable of achieving its objective?
Okay, does it look good on paper?
Sort of, but it's more than just looking good. The auditor gathers evidence to see if it's properly designed to prevent or detect errors or issues. This involves procedures like inquiry, inspecting documents, maybe doing more detailed walkthroughs, reading supporting documents, checking if known risks or vulnerabilities have been considered in the design. They look at things like how often the control runs, who does it, how precise it needs to be.
Again, the second aspect.
The second is operating effectiveness. This is only for Type 2 engagements. Here, the question is the control actually working as intended, consistently, throughout the whole period?
Ah, so not just designed well, but performing well over time.
Exactly. A control could be perfectly designed, but if no one's actually doing it or doing it correctly, it's not effective. An effectively operating control provides that reasonable assurance we talked about.
And if they use that inclusive method for a subservice organization?
Good point. Then the auditor has to test the controls at that subsurface organization too, for both design suitability and operating effectiveness.
Right. Now, you mentioned nature, extent, and timing earlier in relation to risk response. Does that apply to testing controls too?
Absolutely. Those three dimensions are critical for designing the tests of controls. Nature is how they test. Are they talking to people? inquiry, looking at documents, inspection, watching the control happen, observation, or actually doing it themselves, reperformance.
Okay.
They need to understand how the control was applied, how consistently, and by whom. They also look at whether the control relies on other controls working properly. Those are sometimes called dependent controls.
Makes sense. What about extent?
Extent is how much testing, what's the sample size, how many times do they need to observe it. This isn't just a random number. It's based on professional judgment.
What factors into that judgment?
Things like how much deviation are they willing to tolerate versus how much do they expect to find? How often does the control operate? Daily, monthly, annually? How reliable is the evidence they can get? How long is the period they're testing? How important is this specific control? And have other tests already provided some evidence about it?
Lots to consider. And timing.
Timing is when the tests are done. Do they test throughout the year at interim dates? Only at the end of the period? Or maybe even after the period ends for certain controls?
Why would they test after the period?
Well, sometimes the evidence isn't available until later. Think about a control involving a monthly reconciliation report. You can't test the December reconciliation in November. Also, some controls don't leave a clear audit trail immediately, and again, the significance of the control plays a role in deciding when to test.
So just to make that nature, extent, timing really concrete, could you walk us through a quick example? Maybe compare how an auditor tests a brand new supercritical control versus one that's been around for ages and is lower risk.
Sure, great idea. Let's take a brand new, high-risk control, maybe a complex security configuration setting that's vital for protecting data. The nature of testing might involve direct observation of it being configured, plus reperformance. The auditor might try to replicate the setup in a test environment. Much more hands-on.
Okay.
The extent would likely be higher, maybe testing multiple instances or even 100% for the initial period if it's that critical.
And the timing?
The timing might be soon after implementation, perhaps again at an interim date, and definitely at the period end to ensure it's worked consistently since it was introduced.
Got it. Now, the established low-risk one, say a simple manager review of an expense report that's been done the same way for years.
Right. For that, the nature might rely more on inquiry, talking to the manager, and
Yeah.
inspection, looking at signed-off reports. Less need for observation or reperformance if past audits found it effective.
And the extent.
The extent would probably be a much smaller sample size based on statistical sampling or judgment.
And timing.
And the timing might just be once, perhaps toward the end of the period, especially if previous audits provide some comfort. So you see, it's very tailored.
That clarifies it perfectly. It really highlights the judgment involved. Now, shifting gears slightly, auditors aren't just looking for things working well, right? They have to deal with problems, incidents, failures. How do they approach that?
That's a huge part of it. They need to understand the organization's own processes for identifying and reporting system failures, security incidents, complaints, anything that goes wrong, basically.
How do they get that understanding?
Through various means. Discussions with management and staff, reviewing minutes from board meetings where incidents might have been discussed. They might look into whistleblower hotlines, how they work, maybe even test if they're operational. They examine documented policies, user responsibilities, perhaps posted on an intranet, training materials.
Okay.
Also, looking at agreements with service providers, how the system boundaries are defined, and how planned system changes are communicated. It all paints a picture of how failures are handled.
And then comes the big evaluation, pulling all this evidence together. You said that's maybe the most crucial step.
I think so, yes. Evaluating the results.
Yeah.
The key here is that the auditor must consider all the evidence they've gathered. Internal, external, stuff that supports their expectations, stuff that contradicts it.
Even the lack of evidence can be evidence, you mentioned.
Exactly. If they expected to find something and didn't, that's informative too.
Yeah.
And if they feel the evidence isn't sufficient to draw a conclusion, they simply have to do more work, perform more procedures until they have enough.
What happens when they do find problems, deviations, or deficiencies?
They have to investigate. What's the nature and cause? Does a misstatement mean the description itself is flawed or misleading? Are deviations within an acceptable range, or do they signal a real control deficiency? Is the problem isolated, or is it pervasive, affecting many areas?
Right.
Do they need to go back and test controls more thoroughly, even ones they already looked at? How big is the potential impact of these deficiencies? Could users of the report be misled if the auditor doesn't modify their opinion? And critically, is there any indication of fraud or illegal acts?
That sounds intense. What's the ultimate trigger for changing the audit opinion?
If they find what are termed material misstatements in the description, or material deficiencies in the design of controls, or for Type 2 reports, significant deviations in operating effectiveness, then the auditor must modify their opinion. It's not optional. The report has to reflect those findings clearly.
Okay, so the main audit work wraps up, evaluation is done. But you mentioned things can still happen after the period ends, but before the report is actually issued. Tell us more about these subsequent events.
Right, the audit doesn't just stop dead on the period end date. Subsequent events are transactions or other events that occur between the end date of the engagement, say December 31st,
Hmm.
and the date the auditor actually signs off on their report, maybe February 15th.
And these can still matter.
They absolutely can, if they could significantly affect the system description, the controls, or management's assertion about them. If something significant happens, it might need to be disclosed in the report to prevent users from being misled. The auditor has procedures to ask management about these events.
Can you give some examples of events that would likely affect a SOC report?
Sure. Think about serious issues. Maybe an IT director suddenly gives programmers inappropriate access to live production data, allowing them to modify things they shouldn't. That's a big control breakdown.
Definitely.
Or a major data breach involving confidential information. Or discovering forged signatures on critical instructions. Or even embezzlement, what's technically called a defalcation, being uncovered at the organization. These are serious.
Serious breakdowns. What about things that might not typically require disclosure in the SOC report?
Things less directly related to the system of internal control being reported on. For example, the service organization getting acquired by another company, or having a major operational disruption because of, say, a hurricane.
That seems major, but maybe not relevant to the controls themselves.
Exactly. Or significant plan changes to their IT systems, like a big system conversion or outsourcing a function. These might be important business events, but unless they impact the controls during the period audited or require immediate disclosure to understand the current state, they might not affect the historical SOC report directly, though they might be mentioned.
What if management knows about a significant subsequent event but refuses to disclose it?
That's a serious situation. If the auditor believes the event is material and needs disclosure and management refuses, the auditor would likely have to modify their report opinion, or in some cases might even need to withdraw from the engagement altogether.
Wow. And what about things discovered even later, after the report is already out?
Subsequently discovered facts. The auditor doesn't have an ongoing obligation to hunt for new information after the report date. But if a fact comes to their attention after the report is issued, and they realize this fact, had they known it before, would have caused them to change their report, well, they have a responsibility to take appropriate action.
Which could mean?
It could involve discussing with management, ensuring users are informed, potentially reissuing the report. It depends on the specifics.
Okay, one last piece of the puzzle. Written representations from management. This sounds like a formal sign-off.
It is. It's a required step. The auditor must obtain formal written representations from the service organization's management.
What's the main purpose of that?
It serves a few key purposes. It confirms representations management made to the auditor during the engagement, both explicit and implicit ones. It helps document that those representations are appropriate. And it reduces the chance of misunderstandings between the auditor and management.
What kind of things are typically included in these letters?
It's quite comprehensive. It always includes management's formal assertion about the subject matter, like the fairness of the description and the suitability of control design and effectiveness for Tech 2. They also state that they've disclosed all relevant matters, any known contradictions, any communications from regulators about control issues. They acknowledge their responsibility for the system, the assertion, and for selecting the criteria used.
Okay.
They need to disclose any known subsequent events that could have a material effect. Confirm they gave the auditor all relevant information and access. State their belief that any uncorrected misstatements found are immaterial. And they specifically disclose known deficiencies, any known or suspected fraud or noncompliance, significant changes to controls, any noncompliance affecting user entities for SOC1, fraud affecting the report presentation, SOC1, or the system commitments, SOC2, and any significant system incidents, SOC2.
That's a lot they're attesting to. What if they refuse to provide this letter or the auditor thinks it's unreliable?
That's another serious issue. It usually constitutes a scope limitation. The auditor wasn't able to obtain sufficient appropriate audit evidence.
Meaning?
Meaning it likely prevents the auditor from issuing a standard, unmodified opinion. Depending on the severity and pervasiveness, it could lead to a qualified opinion, a disclaimer of opinion, or again, potentially withdrawal from the engagement. It really underscores how crucial management's cooperation and integrity are to the whole process.
Wow. What a journey indeed. We've gone from initial risk assessment through planning the detective work, checking the blueprint, testing the actual controls, dealing with incidents, subsequent events, right up to that final audit opinion and management sign-off. It's definitely more than just ticking boxes.
Absolutely. It's a rigorous, demanding process. But these SOC engagements, they're really fundamental. They're not just about compliance. They're about building that essential digital trust and transparency that our interconnected world relies on. They provide the foundation for how businesses and individuals like you can confidently rely on service providers.
So much relies on this process working well. Which leads to a final thought for you, our listeners. Considering how fast technology and business models are changing, think AI, cloud complexity, new regulations, what new challenges or maybe focus areas do you see emerging for SOC engagements in the next, say, 5 or 10 years? And how might that evolution shape the future of digital assurance for you? Something to ponder. Thank you so much for joining us on this deep dive.